Two stocks I'm buying in August of 2026. This is a video that I do every month, and I let you guys know two stocks that I'm buying in a specific months. The first one is gonna be very interesting. I think the opportunity on this one is asymmetrical because the company could potentially get acquired at a higher price, and if it doesn't get acquired, then you're still buying a pretty amazing company at a low valuation that's also recession resistant, and it doesn't correlate as much with big tech and the market. It tends to do well when the market goes down. The second one is more of a hated semiconductors that I want to talk about. So I really hope you enjoy it as always. Now, the first stock is GFL Environmental. The stock is still down 2% year to date. I started talking about it at $38 and the stock went to like $34 per share, and I was getting comments, people blaming me for losses and all kind of things, and I was buying the dip at $34. Since then, the stock's up 24%, and I want to buy even more of the company, and I'm gonna tell you why. Now, GFL is a garbage hauler or waste management company, whatever you want to call it. They have 90 plus landfills in the United States and in Canada. Those landfills are the moats of this company because no one wants a landfill in their backyard or in their city. You can't really rebuild them. So those there, they stay there forever. And the company owns 90 plus of those landfills. They own a lot of trucks, a lot of municipality contracts, like they manage 100% of the waste in the city of Toronto and in Montreal as well. And it's a pretty interesting business model. Garbage has to be picked up. We have inflation, they have pricing power. We have war, garbage is still here. Whatever happens, this is something that will work, and it has to be done no matter what. The company uses a mix of acquisitions and pricing or organic growth for their revenue model. So if you look at their acquisitions, they acquire them at an average multiple of 7 times EBITDA in the private markets. And in the public markets, those publicly waste management companies, they trade between 13 to 15 times EBITDA. So once GFL acquires it for 7 times, it brings it into the financials. It immediately pretty much doubles the multiple on those things, and it creates shareholder value. Now, if you look at the last quarter, the company posted about 10% growth from acquisitions, 6.4% from pricing. All in all, they grew 16% in revenue, and they raised guidance for the second time this year in 2026. The earnings report was absolutely amazing. Now, I'm trying to keep this one short. If you look at the valuation of the stock, it's trading at about 19 times cash flow. The average multiple on GFL is 22 times. The other waste management companies, they trade at an average of 27 to 25 times because those companies have predictable recurring free cash flow. This free cash flow gets a massive multiple, generally 25, 27 times. The stock went as low as 16 times cash flow. Now it's trading at 19 times. 19 times cash flow is very cheap for this company, as the company is guiding free cash flow growth of low to mid 20% into 2029. So you're buying this amazing recession-resistant stock below 1 times price to free cash flow growth. That doesn't happen very often. And this is why the stock was so undervalued. And I still believe it's undervalued. If nothing happens to the company and they still grow 20 to 25%, I would expect at least a 20% annual return over the next few years with a company like GFL. But there's a call option with GFL right now. And this is that a lot of other private equity firms are interested in acquiring GFL itself. They can't really acquire waste management and waste connections. They're a little bit too big. GFL is the smallest, you could say, waste management company on the market. They're interested in potentially acquiring it. There's a lot of firms that are interested, including Apollo, Blackstone, BlackRock, Oaktree, KKR, BC Partners. A lot of those the big money guys, you could say, they're interested, and the CEO is not going to sell under $50 per share. So if there was an acquisition, he's not going to sell under 50. The stock is trading at $42. So we could have a catalyst this year where if they do sell the company, they acquire them, you're going to get up to $50, $55 per share, which is a massive expansion from here in terms of a price appreciation. But if that doesn't happen, then you're still buying the company at 19 times cash flow, while the company is growing cash flow 22 to 25%. So this is why I'm interested in buying more GFL at today's price, because I see such an amazing setup where I could have massive price realization in the midterm. But if that doesn't happen, in the long term, I can get 20, 22% annual return with a stock that's not in tech, not too exciting, doesn't correlate too much with the markets, and I can buy it and hold it forever, as it's not going to be disrupted by AI, and it will always be here. So I wanted to give you guys an update on GFL. I'm planning to buy more, maybe take it a much larger percentage of the portfolio, and I think the stock is still undervalued at $42 per share. The second stock that I want to talk about a little bit more is Qualcomm. I recently talked about this one, but I got a lot of comments of people that misunderstood my video, a lot of pushback, which I love getting pushback because I love answering, the reasons why the stock is going down. There's always a reason why a stock goes down, and it's normally a concern that people have. And if you can look at this concern, and if this concern is misunderstood, then you're likely on the right side of the trade. Once you're buying stocks, they are hated and in turnarounds, you have to look at why they're going down and if this reason is justified or not. And I believe with Qualcomm, it's a massively misunderstood stock. And I believe the reason why people think it's going down is unjustified. Now, if you look at the latest report of Qualcomm, they pretty much declined 4% in revenues, and they declined 20% in earnings per share. Now, you look at this report, it looks absolutely terrible, but it was actually within the management's expectations. The management were guiding for this terrible quarter. Now, the reason why this quarter looks so terrible is because the handset revenue, which is mainly smartphones are very, very cyclical, and they declined 20% within the company. Now, on the other hand, automotive grew 61% for Qualcomm, and IoT grew 9% for Qualcomm. But if you look at the handset, it was $6 billion. The other ones, even after growing, they're barely 1.5 and 1.8. So the growth of those other businesses are being masked by the declining handset revenue. And this is why a lot of people are not seeing the transition period that Qualcomm is in. And as those other two businesses grow, they're not going to be masked by the handset revenue, and then Wall Street will start seeing it and people could potentially love the stock. But there's two reasons why the handsets revenues are declining so much. The first reason is in China. The Chinese market has been in a down cycle for a while, but the company said that they view Chinese OEM reaching a bottom in the third quarter, and it will return to double digits sequential growth in the fourth quarter. So the company is telling us that a major reason why it's going down is China, and China is bottoming out this quarter, and next quarter will return to double digits growth. So it's going to get better from here for Qualcomm. Now, the second reason why handsets are declining is because Apple is starting to design their own chips, and they don't want to continue their partnership with Qualcomm. So Qualcomm is in the process of replacing the Apple revenue. Now, the good thing is there are other businesses like non-handset. They're growing so rapidly that they expect the non-handset revenue to grow 60% year over year in 2027, and they expect the 60% growth to replace all the Apple product revenue. The Apple product revenue was a huge chunk of Qualcomm, but they are able to replace it with this other business that's growing. But again, Wall Street is not seeing it because one side of the revenue is offsetting the other side of the revenue. The total number is 0% or negative 2%, and people believe Qualcomm is trash. But Qualcomm is entering a major growth trend that hasn't been seen yet, and this is why this opportunity exists. Now, I did get about 2 comments on my last video. They said, yeah, all you have to do is you look at the last 4 years of revenues. It's been cyclical, so you just avoid the stock. Well, that's the lazy analysis that a lot of people are doing, and that's what's causing the stock to be misunderstood, in my opinion, because the last 5 years were something else for Qualcomm. Qualcomm was 100% in handsets. Handsets and smartphones are very, very volatile, but the company is entering a transition period that will start to be realized as soon as 2027. 2027. The company has long-term contracts with BMW and Stellantis and other automotive suppliers. They're the largest automotive suppliers of custom silicon in the world, and the automotive pipeline, they expect it to last well into the 2030s. So those are long-term contracts for Qualcomm. Qualcomm also has two $1 billion custom silicon hyperscaler contracts of $1 billion plus each. We don't know who the customers are, but the rumors are that it's Amazon from the United States and ByteDance, the owner of TikTok and other companies in China. So they also have those two contracts. They also have two contracts, one with Meta and one with Microsoft for their data center business, which they're entering in 2027. And the company is not what it used to be, guys. Like it was 100% into the handsets and all of that. They're transitioning away from it. You know, the handsets are bottoming out. Apple's revenue will be wiped out next year, and then the market will start seeing the growth, the 61% growth in automotive and the 61% growth in other businesses that's not being realized because the total revenue is down 5%. So Qualcomm is trash. We look at the last 4 years, it was cyclical, so we just skipped the stock. All of this could potentially change next year. And I think the multiple expansion on the stock could potentially be crazy. Now, if we look at, again, the valuation, as a CEO, they're guiding $18 plus, over $18 in earnings per share by 2029. The stock right now is trading at 16 times earnings. You could use $18, their guidance, and I would use 18 times earnings, which I think is fair. This is $324. The stock right now is trading at about $150. So we take 324 and we divide it by 150. This is about 116% upside over the next 3 years or so, not including the 2% dividends that I get paid while I wait for this investment to play out. So I think the stock is massively misunderstood. I look on the internet and I see this amazing interview from the CFO. It barely got 1,000 views, guys. This is the CFO of Qualcomm. He posted a 10-minute video explaining a lot of important things about the company. And my channel is getting more views than the CFO of Qualcomm. I mean, is this really how hated this company is, or how not a lot of people are looking into it? To me, that gets me very excited. Again, I could be wrong. Maybe I'm falling into a value trap and the stock will be flat for another 5 years. This is totally possible, and this is why I size them accordingly. I don't go all in Qualcomm. It's a percentage of the portfolio, but I think there's a very high chance that I'll end up being right, and I should know that by, I would say, mid-2027. I think the market will be realizing the value from now till then. So that was my opinion on those two stocks. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.